I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you. Hi everyone, I am Jason Balara and this is the Know Your Why podcast. Today I'm going to do something a little bit different. I'm not interviewing any guests, although it's possible that some of my partners may show up on this. What we're going to do is a bit of a deal recap episode. So we recently closed our first, or at least Lark Capital's first multifamily syndication. So very cool, very excited about that accomplishment, but I thought it would be good for people who are new to the space, have aspirations of syndicating, or people that just want to understand how the process works. I thought it might be cool to kind of go through some key dates and what happened along the way with this deal. So with that being said, here we go. Really the backstory to this is I've been working in, let me back up. The deal is a 76 unit multifamily deal in Decatur, Georgia, which is in the Atlanta MSA. The asset was built in 1972, and it consists of, like I said, 76 units, which are entirely all one bedroom loft style. So it's actually sort of a unique layout for this market. But in terms of how I came across the deal, which I think is generally the two things people are missing is finding or struggling with is finding deals and finding capital to fund those deals. So this one started, 9 months ago. Before that even. I have been looking in the Atlanta MSA for over a year, just looking to try and find, a deal that worked, a deal that when I underwrote, the numbers looked good, the returns were good, felt comfortable sort of sending this deal out to our investors. And so it took a while to find that sort of thing. And the way this one came to me, although technically it was off market, on market, I knew about it before it was on market because I had already built relationships with the property manager in the area. So I had been introduced to the property manager at least a year ago now. And he and I had looked at a number of deals together. He had gone out and walked them, sent me pictures, things like that. And none of the other ones had worked out. This deal, when it came to him, he had been speaking with the broker, and he thought of me and told the broker that this might be a good one for me, which I will be forever grateful for. It was a very big help in terms of getting in front of the brokers and having this, sort of go my way. So anyway, he made the introduction to the broker. The broker sent me the offering memorandum. I ran the numbers, did some underwriting, and initially I didn't believe it because everything I had underwritten, and this is common in the space, just wasn't even close for what they were asking. And this one, as it turned out, at the asking price was actually a good deal with reasonable returns. And so I think I underwrote it 3 or 4 times, just over and over again, making sure that I wasn't, messing something up. And so when it looked good to me, I again reached back out to the broker and I said I would like to make an offer. The offer was based on kind of what he had said that the seller wanted. And so since this is a seller's market, sort of in a way locked into kind of going for what they wanted, because if you don't, likely someone else will. And so I had offered what they had asked, in essence creating a preemptive letter of intent. And so the idea was that I was actually making this offer before it went to market. As it turned out, the seller decided they wanted to go to market anyway to see, I think, if they could do better. And so my offer was submitted. They went through the marketing process, not for a very long time, maybe 2 weeks, I believe. And this actual initial letter of intent was submitted back in May of 2021. So quite some time ago. as I mentioned, they sort of went to market. It took a couple of weeks. At the end of the day, they went ahead and allowed me to go into the best and final round with my offer, and which involved, upping the price just a little bit, and also having a buyer's interview with them, so which they asked me a number of questions, and apparently my answers and my offer were satisfactory because they ultimately did accept the offer. However, there was a stipulation. So the stipulation to accepting my offer was that the seller has, I believe, they had recently kind of created their own lending arm. They're a pretty large company. They had created their own lending arm, and they wanted me to use their lending arm. They wanted me to use their lender as part of the deal. And so I didn't inherently have a problem with that. However, in order to protect myself, I had a clause built into the purchase and sale agreement that said if their lender was unable to deliver satisfactory terms, that I would be able to go ahead and seek other financing and have an extension to do that. So I think, especially in this seller's type market, there are going to be concessions to be made. And I think that it was a reasonable concession. As I move through the story, you'll see how that kind of turned out to be a problem. But I wanted to, do a deal. I wanted to do this deal, and it was part of what they wanted for me to get the contract signed. So I went ahead and agreed to that with that stipulation that I would have, sort of an out clause plus extension to go ahead and find my own financing. So once that letter of intent was accepted, there was part of their requested components to the deal was that they wanted earnest money to go hard, essentially right away. And so what we did, we built in a pre-access agreement, which is something that I had been previously unfamiliar with, but basically gave me 7 days to go and tour the property and do as much due diligence as possible before the purchase and sale was signed and the earnest money went hard. So went ahead and signed that access agreement, flew out to Georgia virtually immediately to tour the property and did the walkthrough. So we did a lot of the physical due diligence before technically the purchase and sale agreement was signed. So went through that process, got the purchase and sale agreement signed after that pre-access period, and then sort of went to work with the next steps. That pre-access period happened in July, and the purchase and sale was actually signed on July 30th, which again included that seller's lending group financing stipulation. So at that point, we had, honestly, most of the physical due diligence had been done. We had done all the walkthroughs. Our property management team had been on site and started with a lot of the bids for the CapEx work that needed to be done and everything like that. So we were well on our way, and really the next steps were kind of completing that, the lease audits, but really securing the financing. So that, that process went to work. We were working closely with that lender's mortgage or the lending broker, and he would keep us updated. There was a group of us partnering together for this deal. And so, sort of getting everybody's information in and everything like that and going through the process, to which he then shopped the deal around to a number of different lenders, and was to come back to us with some different bids or different quotes for term sheets on the lending, at which point we could choose one and kind of go forward from there. At the same time, we are sort of creating our pitch deck, starting our to get this deal out to investors, and starting all of the legal processes and paperwork to get the private placement memorandum written up and get everything in place to actually close the deal. So on our side of things, in terms of the legal process and the capital raising and things like that, things went extremely well. We were able to raise the capital for the deal really quite quickly. And from our end, we were getting ready to close. Initially, that was supposed to be at the very beginning of November. And so we had sort of gone through that process. The term sheets that we were presented by the lender, only one of them really had desirable terms that we felt were feasible to make the deal work. And as it turned out, it was an agency loan. And so we were presented with actually quite favorable agency terms. Anyone who's familiar with agency debt, we're talking about getting essentially a loan from the government, and that loan, that process, there's a lot of hoops to jump through. The government's not going to give this money unless all the boxes are checked and checked again and checked again. So very, very sort of tedious process. However, ultimately, oftentimes some of the best interest rates that you can get. So there's some reasons to go through the process. But as we moved through that process, it initially seemed like things were going well. We were getting all of our documents together. As it turned out, we got maybe about 2 weeks before we were supposed to close, and we're speaking to the lending team, and there started to be questions raised, questions on the seller side in terms of some of the delinquency and bad debt and how it was being reported and how they were doing their accounting. So basically what happened is that as Fannie Mae, sort of dug deeper and deeper into the seller documents and their rent rolls and delinquency reports and all of that, as it turned out, they were not really keeping up with the delinquencies. They were not doing anything about the bad debt. And so as we got closer and closer to closing time, it was kind of this scramble where literally the week leading up to when we were supposed to close, every day I would speak to someone on the lending team who would essentially tell us, hey, I think the loan proceeds are going to be a little bit less than we thought. And at first it was 100,000 less, and then it was 200,000 less, and then it was 500,000 less. And so, as you can imagine, as those loan proceeds were dropping, that also drops the returns for our investors, and it increases the amount of capital that we would need to raise. And so there was a point at which we figured we could still make it work because we had underwritten very conservatively. If we needed to raise a little bit more capital, that wasn't going to be the end of the world. It was still, maybe eating into some of our CapEx contingency budget, but we still felt like we could do it, make the deal work, and it would be a good deal. However, again, like I said, it got closer and closer and closer to closing date, and ultimately, at that point, they were basically telling us our loan proceeds were going to be close to $1 million less than what they had initially told us. Not to mention that triggered the small loan balance, that triggered the amount to be down now a small loan balance, which is something that for agency debt, that's less than $6 million in loan proceeds. And so those loans are actually carry with them usually a higher interest rate. And so basically it became this sort of chicken and the egg thing, where it was like our loan proceeds were dropping, therefore our interest rate was going to go up, therefore our loan proceeds were going to drop accordingly due to the interest rate raising the payments. And so essentially it just got to the point where it was very clear that Fannie Mae didn't want to do this loan. They just didn't believe in it, didn't want to do it. And the fact is that in reality, right from the beginning, we thought that this should be a bridge debt transaction. However, like I said, we had been locked into using the seller's lending team, and the best term sheet that they could get us was this Fannie Mae loan. And so there's a lot of reasons behind it, but ultimately I think it had to do with people knowing each other and trying to make each other sort of look good and over promising and under delivering. But at the end of the day, none of that really mattered. What mattered is that we reached a point where we couldn't do the deal anymore because we weren't going to get good returns for our investors, which is always priority number one. And so we had to pivot. We had to decide where we were going to go from there. And the sellers, I think difficult would be maybe an understatement, but the sellers came. We said, we still want to do this deal. Obviously, we're going to need an extension. We're going to need to find a new loan. Are you willing to do that? And so otherwise it was going to be a matter of sort of terminating the deal. We didn't want to terminate the deal. We just wanted to go ahead and find bridge loan. And we were going to move away from their lending team. And so to that, they responded that they would like to raise the purchase price of the asset, which I won't go into what I think about that because it's not very friendly, but the reality is that it's a seller's market and we were a little bit stuck. And so we negotiated that. We ended up getting it down to paying $100,000 more for the property than was initially agreed to. So that's again, it's all about the returns. It's all about what we can do for the investors. And at that point, we still felt it was a very good deal. And in reality, the bridge debt loan that we were able to obtain made the returns actually better than they were going to be with the previous loan proceeds. So it was, in effect, reasonable. We felt on our end to pay a little bit more, despite the fact that ethically, I think that was really the wrong thing for them to do. So regardless, we were able to come to an agreement. We got an extension. We went ahead and secured bridge debt through another lending company. They were fantastic to work with, and I look forward to working with them in current and future deals. So thanks to the new loan or to the new lending group, we were able to secure that bridge debt. As I had mentioned, everything else on our end had gone extremely well. We already had the capital sitting there waiting to close. As it turned out, with the bridge debt product, we actually needed less capital. So it really all in all worked out from a numbers standpoint. Though again, it's not how I would do business. So ultimately, when we created this extension and amendment to the contract, we signed that on November 7th. And for a outside close date of December 15th, we actually ended up closing that deal on Monday, December 13th. All in all, it worked out, right? So there's a lot of lessons here, I think, to be learned. And one of them is that, these things take a long time. And so I started this journey over a year ago, but we started this particular deal back in May. So May of 2021, it's now December of 2021. So we're talking about a good 7 months, right, to get this to the finish line. And so a lot of roadblocks come along the way, and with each one, we had to, come up with a solution and kind of work through it. So if you're determined and you're willing to kind of push past some of the garbage that comes up, it's well worth it. It's well worth the journey. And what I'm especially excited about at this point for this deal is now we get to go in there and actually turn around a very mismanaged property where the tenants have been treated poorly. And so that's what I'm excited about, right? I'm excited about the ability to do that, to make this a really desirable place to live. And while simultaneously providing great returns for our investors, I'm very excited because some of the investors that I have brought in are veterinarians. And as I've mentioned on other podcasts and in my social media, a big part of my why in this process is to help veterinarians find a way to generate passive income so that they can actually sort of free themselves from the extreme stress of the veterinary profession, at least from a financial standpoint, which I think will help a lot of people. So I'm very excited about that. I wanted to touch on a couple of, sort of takeaway lessons that I felt were very important things I learned. I learned a million things. I don't think I can necessarily go through them all, but a few I wanted to touch on sort of three that I felt that were really kind of key in this lesson. One, first one is financing. I think financing is the single biggest component when it comes to, sort of maximizing returns on these deals. So the financing terms, how you structure it, kind of there's all different components that go into that, but really understanding that and kind of digging in deep and having a good lender to go to, and it's out there. Like, this is not new information. I'm not saying something that people don't know, but it's was really kind of hit home for me. It was in terms of how important that is, and kind of what an impact it can have on you. Because as I mentioned, although it was a pain and a difficult process to go to, it actually worked out better in terms of what our investors are going to get for returns switching to this bridge debt product. And so I think it's very, very key to understand the ins and outs of financing. And it's also another reason why so many of us in the real estate investing space are so keen on, why this is such a good time is because interest rates are incredibly low. So you can really, really use that to your advantage in terms of sort of maximal impact of your returns. So take home number one, lending is extremely key in the process. I guess take home number two, I would say, is that it is a seller's market. And I guess that can't be stated enough, because as I mentioned, some of the hoops that we went through, these sellers were difficult. I wouldn't do another transaction with them. That's just, it was worth it to get one. It was worth it to get this deal, but I wouldn't do it again, because I prefer to do business with people that I enjoy working with. And so for me, that will be a strong component moving forward in deals that I do in the future, and people that I work with, both on my team and externally to my team. I think the whole reason for this is, for it to be something I enjoy, something that can make the lives of my family and my investors better. And so if it's a constant grind because we're dealing with people that are difficult, that it won't be something that I enjoy. And so it again, not to harp on this particular seller anymore, but the point is, it's a seller's market. And so there were things that we did, concessions that we made, because they're sort of in the driver's seat. So, someday it won't be a seller's market and things would be different, and you might agree to things that are, or you might not agree to things that you would agree to now. But it's important to know that. It's important to know the market that you're in, the climate of these transactions, and your brokers will guide you in that. But ultimately, you just have to kind of know how things are working. And so whether you like it or not, there are probably going to be some concessions to be made if you're buying in this market. And so, and if you're a seller, maybe think about that it won't always be this way, and you can be, be someone who's good to deal with. And then the final thing I would say as far as take home is I would just want to thank the partners that I worked on this deal with. I think we've all, contributed in major ways, and I think we navigated through this without, this was our deal as a group together, our first deal as a group together, not the first deal for everyone, but first deal as a group together. And I think it was really, they say that this is a team sport, all of the cliches that real estate is a team sport, especially, syndication, that your network is your net worth, all of these things. But certainly I couldn't have done this myself. And I'm grateful for the partners that I worked with, and thankful for them. I look forward to working with them more. But I think it is key to find people that you can work with and that your strengths and weaknesses complement each other. And so having, people that can fill in the gaps where maybe you're lacking and vice versa, I think is incredibly key. Well, to life in general, but also, certainly to these real estate transactions. So I think that's probably really a good short wrap up. Please reach out to me if you have any questions. You want, more details on how certain components went. I'm very happy to go into it. I think it's extremely interesting, and especially for those of you who are trying to get into the space and understand how it works. I learned a tremendous amount during this. I certainly know that there's more to learn, but little things that, kind of aren't out there in the books and aren't out there, on the podcasts. They're things that you might just learn. You're only going to learn by doing. So I'll wrap it up there. I hope everyone has a good day, and please, I look forward to sharing more deals with you in the future. Okay. Take care, everyone.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Balara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.